So investment properties can actually not be the right investment when it comes to putting your cash somewhere. So this goes on following a post that I did last week. Got a lot of comments, a lot of private comments, where people were sort of thinking I was dissing property investment, which I'm not. I'm just saying that there's alternative types of investments that can produce a return that could be greater than owning an investment property. So if we look at this example, which I put here, it's just a very basic one. The purchase price of a property is $750 with a deposit of $150, meaning you get a loan for $600K. That investment property will yield $750 a week, which is $39,000 a year. And this is the figure that most people based whether they enter the decision to buy an investment property on. They look at the gross yield, which is basically the amount that the property produces in rental income versus the purchase price. So if you look at this figure here, 39K over 750, you're thinking, wow, a 5.2% yield, that's pretty great. You know, it's in terms of long-term investing and something that's really stable. This type of asset, you'd be like, yeah, that's great. But the problem is, if we're just looking at gross yield, it doesn't give a good underlying figure of what the property is actually producing. Because if you had, say, $600,000 in the bank would give you about 5% interest, and that'd be gross yield, because there are no other expenses apart from tax. So you'd put the money in the bank. At the end of the month, they would then pay you interest each month, and that would be your return. But with an investment property, it's a bit different. You've got your income, which is all the money that's coming in, then minus all of the expenses. So here you've got an interest-only loan for the purposes of the example, to make it simple. Then a lot of your expenses, like rates, water, insurance, your real estate agent, and the biggest unknown is your maintenance. Of course, if you buy a property that's newer, the maintenance charge will be lower, hopefully. If you buy an older property, then this charge is generally higher. So if we look at this example here holistically, this property, yes, it's giving you a 5.2% yield, gross yield. But each year, the property is costing you $12,380 per year. So that's $12,380 per year extra that's coming out of your pocket to service the loan. So it's costing you about $1,000 a month extra out of your pocket. So really, the property is not generating you any income at all. It's costing you an extra $1,000 a year. Where investors get a bit prickly, it's like, yes, the property will go up in value. Okay, that's assuming that the gains that have happened in the last few years continue to happen. And the gains that happened in the last few years are very unrealistic, because gains of 10 or 15%, they don't usually happen in the property market. And if you look back, going back 10 or 15 years, the average is about 3 to 4% per year. So if you're looking to invest in property, look at the net yield. The net yield is what you make as well after you pay all of your expenses. So when looking at all of these percentages, don't just look at gross yield, look at net yield, look at return on investment, look at all the different type of metrics before you make a decision to purchase investment property or not.
Yeah, that was a really great example, Andrew, and it really highlights the differences between gross yield, which people will just naturally use as a quick benchmark. Definitely useful, but it's not the full picture. You actually have to calculate your actual costs to determine the real profitability of that investment. And yeah, especially when you go into different markets, including interstate, you realize the differences in all of these different numbers you have here as well. Like, for example, with insurance, if you're going somewhere like regional Queensland, for example, because they're more flood prone or bushfire prone, the insurance is a lot higher. If you go to WA, I know, for example, the agent fees are technically also higher compared to other states as well. So there's all these different variables and levers that can change from different markets and different states. And so when you're assessing different markets, the yield will be different. So again, just calculate your true cost and the net yield, like Andrew has demonstrated here.
Yep. And I've also used a 20% deposit in this example, but there are a lot of people going out there and purchasing properties with 10% or 5%. So this number is generally a lot higher and also a lot more sensitive to interest rate rises or cuts as well. So if you're looking to buy a property, make sure you take all of these different factors and percentages and metrics into consideration before you hit the trigger. Alrighty, that's it for today, and we'll catch you soon.